We don't want it to drop. If it does drop, yeah, we can make more. We really don't want it to drop. It's a bullish strategy. This is just this trade here, this bear part is just acting as a small hedge for you. Okay, just acting as a small hedge. You really don't want it to drop. But if it did, you have some cushion. You have a 20 delta difference in this example here. This is at the 30 delta, the bear part here. This is at the 10 delta. So you have a 20 delta difference, which is pretty significant. Okay? This is the bullish bear. So I like to do the bullish bear most of the time in the ES because you can see the kind of dynamics of the buying power here. If we did it in the ES, it would change up quite a bit. So so now you can see that we are receiving $200 in credit over, let's say, $1,000. So that's still awesome, right? That's 20% return on your capital right then and there, significantly better than the previous one. All right, so let's talk about a bullish bear. Okay, let's talk about the bullish bear, and I'm going to use the SPY for a second, just so we can kind of demonstrate, and you guys can know. All right, so we really have a kind of a cadence to almost everything we do, you guys, for trades that we do often, and so the bullish bear is no exception to that. We are trying to buy a put spread at or near the 30 delta. And so in this example here, this is the 30 delta, and I'm buying it a put spread, and I just say I did 1 point wide here. So this is going to cost me $22 before fees and commissions, and the most I can make is on this is $100 before the amount I paid. So if I'm going to pay, I'm just going to lock this at 22. If I'm going to pay 22, then the most I can make is $78 off the trade if I was going to just do a standalone buying of a put spread at a 30 delta. And you guys know my chances of winning on this would be a 30% chance of making at least something because of this 30 delta that we're buying it at. But this is a bullish bear is not just it's not a standalone put spread by itself. But if it was, this is how it would look. And the way we set up the bullish bears is that we would be, 1 to 5 points wide usually. So if I was going to do something 5 points wide, it'll look something like this. And then this would cost me, if I lock this here, let's just say $100 for easy math. This would cost me $100 to buy this put spread, and I can make up to 400. So 500 minus the premium I paid, which is 100. So I can make 400 if this was a standalone put spread, if we bought that was 5 points wide. As you guys know, if you know the basics, this options on stock is 5 points wide. Every point is $5. So $100. So you take the 5 times 100, and that gives you the 500 that I'm talking about, minus the 100 that you're paying for it. So that's why the most you can make on this bear standalone put spread is $400, not including fees and commissions. So that's not bad cost wise. Your odds on winning are only about 30% of winning something. Okay? So it's not, probabilistically, it's not a great trade if you were just doing a standalone trade. But we're doing the bullish bear. You also going to sell a put spread, and that's bullish. So in this example, let me just delete this part for now. And if we went down to let's just say we went down to a 10 delta in this example here. We went down to the 10 delta, and let's just say we did a 10-point wide spread. So that would take us to here. And so we would collect $53 here, and which is not a lot, because you guys remember, if we were doing a 22-point wide spread or 1 point wide spread, we were getting $22. So in this example, we were basically got $30 on this trade. So nothing to write home to moms about. But this is the dynamic of it is that when you're doing a standalone put spread that you're selling, then your risk here is 10 times 10 times 100, right? Because each point is 100 and it's 10 points wide. So this would equal $1,000 minus the premium we receive. So in this case, we're receiving $55. So the most we can lose on this is $945, and we would have, though, a 90+% chance of winning on this trade because we're selling at the 10 delta here. we're kind of sacrificing or trade-offs of the probability of winning is high, but the amount we can lose is more than obviously what we can make. So it's trade-offs. I usually obviously like to have the higher probability and don't really think about the the max loss to to a huge degree, because I'm not expecting to have that max loss, because I will adjust and things like that. You shouldn't have that max loss. So I'm going by that probability of success. So that's how the trade looks there on the standalone put side. If I go and do and buy at the 30 delta again and finish off the bear part again, you can see that we're receiving a credit of $30 here, and the buying power required is 868. So the return on capital is horrible on this trade here when you're doing it on an SPY. And I wouldn't do this trade in probably in any situation because it's not attractive enough. But I would do it by adding puts another put spread on the bull part, but it's not going to be great return on the capital still. This is a 10 delta here, and the market is not giving you a lot of premium on that, so you're only getting $84 in this scenario, and the buying power is really high. So this would be a non-standard trade. I still wouldn't do this one because once again I would want at least $100 on the trade, even though I wouldn't be getting a 12% return on my capital. Wouldn't be a standard Dorian Trader trade, but it's something that I would still do if I was getting $100. So, but I wanted to kind of show you the dynamics of the trade, and then we're going to go to this curve view real quickly, and I'm going to try to make this a little bigger for everyone. All right, just a tiny bit bigger. There we go. So if we did it like this, you can see that this is the at the money line. If it goes up, we're going to win 100% of the time. This is a bullish strategy. But if it goes down, we can actually win more if it lands in between the two short strikes, the short strike on the put side here, and these two short strikes here. So the short strike on the bull part, and the short strike on the bear part. And so as you can see here, we're collecting $87, $89, but the most we can win is 187, 189, because if it falls in here. But we don't want it to do that. We really want it to go up. That's why I would rather have $100, because we don't want it to drop. If it does drop, yeah, we can make more. We really don't want it to drop. It's a bullish strategy. This is just this trade here, this bear part is just acting as a small hedge for you. Okay, just acting as a small hedge. You really don't want it to drop. But if it did, you have some cushion. You have a 20 delta difference in this example here. This is at the 30 delta, the bear part here. This is at the 10 delta. So you have a 20 delta difference, which is pretty significant. Okay? This is the bullish bear. So I like to do the bullish bear most of the time in the ES, because you can see the kind of dynamics of the buying power here. If we did it in the ES, it would change up quite a bit. So, and let's see if we have a 51. We do have a 51, so let's go there, and then let's buy at or near the 30 delta. In this example, we want to do a 5-point wide. So this is a perfect example when I say at or near the 30 delta. If I went to the 30 delta here, you can see that this is a 10-point wide. I don't want to do 10-point wide. It's going to cost too much for the bear part. If I went to the 29, or the 28, it's still 10 points wide. I could go to the 27, but if I go to the 32, then there's the 5-point wide. So in this case, I'm going to the 32. I'm going to the 32 now, 31, and that's going to be 5 points wide. And so the ES, everyone, is half the size of the SPX, or the SPX is $100 per point, like all stock options. This is the denominator for the ES is $50. So you have to take 50 times 5. That would be 250, right? So the most you can make is 250 on the bear part, minus the premium that you paid for it, right? So we're paying $67. So the most we can make on the bear part here is 187. So now if we're gonna go put on the bull part, let's go down to the 10 delta like we were before. And let's look at this 10 delta here. Let's do a 100-point wide here on this, and that. So here we go. So now you can see that we are receiving $200 in credit over let's say $1,000. So that's still awesome, right? That's 20% return on your capital right then and there, significantly better than the previous one. But let's just say you don't want to do a 100 point wide. Let's see if we did a 80 point wide. Well, that's still really nice. 175 over 800. If you wanted to do a 60 point wide spread, that's still nice. 125 over just under 600. So you can see why I'd like to do it in the ES, because your efficiency, your capital, the use of your capital is a lot more efficient, and your obviously the buying power is so much better. So this is why I would do it in the ES and instead of the SPY, but obviously sometime I do it in the SPY as well. But in this case, I would do it in the ES. And if I wanted to get further away, I just say I wanted to do something like at a 7 delta and do the 100 point wide spread. So let's just say I went to the here. Let me see, where's the 100? Where's that? Yes, that's the 100 there. So this right here would still give me $120 and over 834. That's not the return on capital is still meets our criteria. But what's attractive to me about this is that the the S&P 500 is going to be around the 10% down from the highs is around 47. I just say 50. And that's not the exact number. The exact number for the SPX is 4737. So for the ES, I just say it's around there too. They just say 4700, right? So 4700 is 10% down. Or in this example here, you're at the 4590. You're 110 points away from there. And if we take that, let's just say we take the 4590 and we do the percentage move. We kind of get the percentage formula. We take this 4590 minus this last number divided by this last number. So actually I want to use this number over here. When you're dealing with futures, you have to make sure you're looking at the right number. So in this example here, we're going to take the 4590 minus the 5105 divided by the 5105. That's going to give us 10%. So we're 10% down from where it's currently trading at, which is already down, let's just say 5% from the highs. So this gives you a safety, you know, um, um, a safe spot for the market to continue to fall, and you still have a degree of safety or air or rope for the market to kind of go down some or even a decent amount still, and you're still good. And this is why I love these type of trades, because I can get so far away using this ES percentage wise, and it allows the market to have its ebb and flows and go down a lot, go up a lot, and we're still fine. And so if I'm wrong directionally, meaning that this is a bullish strategy, if it starts to go down, I have to be wrong in a significant way before this trade becomes a problem for me. And you guys know we're going to make an adjustment before it gets in the money. And once it gets in the red zone, maybe around 35, 40 delta, we're going to make an adjustment. So it would have to go to from a 7 delta in this example to, let's just say, a 40 delta. So that's a 33 delta change. It's a pretty significant drop for us to before we have to make that decision to roll this away or roll it out, or whichever decision we make at that time.